Henry Dixon is co-founder and fund manager at Matterley Asset Management with £150 million under management. Joins me now. Henry, thanks very much for coming in. So I want to start with a very general question on market sentiment right now. I mean, what has investors so worried, so fearful? Why are they freaked out?
Well, we've had a losing streak that is similar to what we saw in Q4 08. Clearly, the focus has shifted from financial institutions to governments, because, if you like, governments have become the residual owner of those financial institutions that were in so much trouble. All I would say is, as I say, the losing streak is similar to that we saw in Q4 08, and had you bought shares in Q4 08, 1 year later you'd have been an extremely happy man. So, I mean, it's always said that, you know, the market is one of the few markets, the equity market that is, as prices get cheaper, investors like to sell. But I think what we are seeing from a corporate perspective is that 1 in 3 companies now in the UK is net cash. If you think the picture sort of 4 or 5 years ago is, let's say, about 1 in 10. So if you like, there's been a huge pickup there in the health of those businesses. And I think what you're seeing with the businesses with a huge amount of net cash is that if their shares have fallen by about a third, as you transpose that to the enterprise value because of the cash backing, you've seen falls of 50% plus in some of our best franchises, I think, in the UK. And I think that looks too harsh. I think these businesses will be in business this year, they will be in business next year, because they have that safety cushion. And I think it's those types of businesses that we're trying to expose ourselves to, some of our best franchises with the cash backing at a very reasonable price.
Yeah, that's interesting. Your comments echoing our earlier guest, James Bevan of CCLA Management, saying that he likes strong companies, strong balance sheets. You're saying you like cash-back companies, essentially. Can you be specific in terms of industry group?
Well, as I say, I think times like this you need to be very, very stock specific, but maybe I could single out AMEC. It has a lot of long-term contracts. It drills, you know, for many oil companies. It's also moving into nuclear. But that now has a third of its market cap in cash. Its PE will be just below 10. So you strip out the cash, we're looking very undemanding. It's yielding, you know, very much more than gilts here and now, and there's a very, very decent chance that yield grows from here. So I think that's the situation of a business that's fallen 25%. If you transpose the fall to the enterprise value, it's very much higher, and I think that looks, you know, overdone. I think on a year view, you'll make a lot of money if you buy shares like that.
I mean, you're echoing comments that we got from Temple Asset Management's Mark Moby, saying actually stocks are looking even better now amidst all the turmoil. Do you agree with that? Good opportunity.
Yeah, absolutely. I think the big thing that you can hang your hat on is that there is no real cause of concern for debt in the UK. Rewind 4 years, I think you could maybe look at, let's say, 1 in 3 companies in the FTSE, and you think, oh, that might need a rights issue, that might need a rights issue. Now you look at the market today and think, you know, where is the cash call coming? Now, clearly, you know, our banks are under pressure, but I think the solution there is just to keep interest rates very low. And if you like, this growth scare is making the grounds for low interest rates, I think, very much stronger for a long time. I would say every strategist is putting back his rate rise. And one thing that people aren't talking about at all is that we've seen the oil price fall by near enough 30%.
Yeah, what do you think about that? I mean, that was a big problem that we were all speaking about just a month ago, and now it looks like consumers maybe have some breathing room.
Oh, absolutely. I mean, I think if you think of the sort of stimulating effect that will have on a US consumer as he goes to the pumps, I mean, it's absolutely enormous. But again, we don't like to talk about it when things are like this. But there are automatic stabilisers out there for the system, and I'd say a falling oil price is very definitely one of them.
And despite what you say about corporate balance sheets, the companies that you like, I guess, you know, the overarching concern right now is that growth is slowing, and that's going to translate into potentially poor earnings growth, particularly for banks. It's going to hit the bottom line of some of these companies.
Yeah, oh no, absolutely. I think there are only six countries in the world that can balance their books and make a profit. So that is sort of concerning. I think, as I say, to use the word unprecedented there again is a bit much. I mean, many countries have defaulted on many occasions. Clearly the US hasn't, but even in this country we've defaulted twice in our history. So as I say, if you go far enough back, you can find out situations of default and then what is needed to be done to get back on your feet. And the example I like to use is, no one talks about Iceland today, but Iceland's stock market this year is up 7%. You know, that plays India down 15 or 20. But what needs is currency weakness for those countries that are in the most trouble. And as I say, it's a very stimulating effect for GDP. So Icelandic GDP this year will be 4%, for example. So as I say, there is a sort of a blueprint that we can use to get ourselves back together, and it will all be done through the currency, and it will all be done through inflation.
I mean, you mentioned currency weakness there, and central bank intervention to weaken currencies has been a very specific theme this week, hasn't it, with what we've seen in Japan and Switzerland. I suppose all bets are off the table if we see more QE, not just in the US, but elsewhere.
Yeah, I think we'll see a few things by Christmas. I think we'll see Chinese stimulus. I think they've been really reining in the growth there. I think we will see more QE in the US, and I think it needs to be sort of, with regards to the housing market, that we need to see more QE there, because I think that's such an important plank of consumer confidence. I think in this country we ought to probably try and avoid QE, more QE actually at this stage, but who knows, we may need it by Christmas. But we've actually had some P8 PMIs, which maybe while they're slightly below where we wanted them, they're still, indicative of growth. So I don't know, all is not lost just yet. And as I say, there's plenty of companies out there with the cash, and they will inherit the earth, you'd have thought, next year. So we'll see how they get on.
All isn't lost yet. Henry Dixon of Matterley Asset Management, thanks very much. Good to talk to you.